Okay, uh, let me talk about the economic turning point that was reached this week and quarantining Wall Street. Today, about the middle of the day, the authorities of the Treasury and the Federal Reserve, which are now in constant communication with each other, realized that the Treasury's auction of 30-year bonds was failing. I can give more details on that, but the important thing is that the last time this failure to sell U.S. long-term government securities occurred, to our knowledge, was in 1861, just after the start of the Civil War. That event necessitated, on the part of the Union government, the issuance of greenback currency by the Treasury. We can consider what happened today the eruption of helicopter money by the Federal Reserve rather than going to a policy of issuing greenback currency. The Federal Reserve responded today with an absolute avalanche of so-called liquidity, provided liquidity, promised liquidity, $1.5 trillion in total, directly buying and committing to buy $1.5 trillion worth of Treasury securities of all kinds. This is called issuing helicopter money to the Treasury directly for spending, which the Treasury otherwise would not, and in this case could not, raise. Now, this was explained by the Federal Reserve in one of its several statements today as responding to severe stress in the Treasury sales market. Think for a minute about that. The U.S. government debt market for 150 years has been considered to be the one market in the world which could not be stressed, the one market in the world which had access to so much liquidity, so much demand, that it was never in stress. It was not in stress in the crash 10 years, 11 years ago. It was not in stress during the Depression. But it was in stress today, and the Federal Reserve essentially intervened through some repurchase markets, but nonetheless, in effect, directly purchasing and promising to purchase $1.5 trillion worth of U.S. Treasuries, which otherwise could not be sold. This doesn't just promise a great inflation. It exposes today's complete dependence of the U.S. government in selling its debt on investment banks, on hedge funds, on other speculative financial firms, which at the moment suddenly find themselves illiquid in a galloping credit crisis and unable to support the Treasury market. And it's a sign of the futility of this helicopter money move that it accomplished nothing but making the day's 30-year Treasury bond sale possible. The Treasury rates remained higher. The stock market remained far down. Once again, in fact, it went considerably further down. Let me just quote one report late today after this was all over and the markets had fallen by nearly 2,500 points. This is from the news aggregator site, Zero Hedge, in the evening. Quote, today's total liquidity injection between the two-term and one overnight repo earlier, combined with a 3-month mega repo, that's repurchase agreement just now, the Fed has injected a total of $276.5 billion in liquidity in one day, and yet stocks have tumbled back down to session lows. Traders realize that what is ailing the market is not access to the Fed's balance sheet, but an overall recession that will collapse revenues, profits, and cash flow of companies, and which the Fed's liquidity injections are powerless to prevent. The Fed tried to fix whatever is causing the structural problem at the heart of the market's illiquidity and has so far failed, which means that absent another emergency bailout attempt, we may very soon have a market holiday and a bank holiday. Finally, for those asking just what kind of bailout attempt they would be, Recall that recently both, these are two Fed governors, one former Fed chairman, Eric Rosengren and Janet Yellen, said that the Fed will have to buy stocks during the next crisis. Well, this is a crisis. What's happening is that because of the immense bubble of corporate debt, which was built up since the 2008 crash, the coronavirus slowdown in economic activity is triggering a credit crisis through the threat of bad debt losses. I won't go through the details of this, but it was clear from what you just heard. It is not that the coronavirus is causing a crash. The coronavirus is clearly causing a global recession. Much of the world's economies were in, certainly all of the European economies, the Japanese economy, were already in manufacturing recession. Before that, many of them were in technical recession, including their service industries and everything else. This now guarantees pushing the United States economy also into recession because of a shock disappearance of demand of all kinds for air flights, for stores, for payment services, for hotels, for on and on, and for aircraft, for on and on and on. Layoffs are occurring so far, not many, but this is merely indicates that there is some strength to work with. There was large job growth in February. There was even unusually large weekly real wage increase in February. That means there is something to work with on the part of the labor force. But what's happening is that the lack of credit now, which is coming from this credit collapse of the last 12 years of central bank money printing. It's not coming from the coronavirus, but the threat of depression of recession from the coronavirus has triggered a collapse of credit. It's rapidly making triple B rated or just above junk companies into junk. It's rapidly making zombie companies which don't have enough income even to pay their interest on their debts into bankrupts. And this is now sending its contagion into the banking system itself. $276 billion in Fed injections in a single day were not enough to turn this credit crash around. Now, even financial economists at this point recognize that the American non-financial corporate debt bubble is likely to blow up in an explosive manner. There have been analysis articles on this in many general circulation newspapers during the course of this week. That bubble is estimated at from $11 trillion to $16 trillion in size, depending on what categories of debt are included. The junk debt part of it, of that corporate debt bubble, is about $4 trillion. That's easily a lot bigger than the subprime mortgage bubble, which melted down in 2007-08. So the stock market gyrations of thousands of points, usually down, are simply a sidelight of this exacerbated credit crisis, which is the fruit of the last, in particular, the last 12 years of continuous money printing on the part of Federal Reserve and all the other central banks. So that what essentially became suddenly dramatically very clear today, when the Treasury suddenly found itself on the verge of being unable to sell long-term debt for the first time in more than a century and a half, is that the Treasury's dependence, the U.S. government debt's dependence entirely on financial companies, hedge funds, private equity funds, and similar investment banking units all over the world to buy treasuries, had created a situation when suddenly, when those kinds of firms found themselves illiquid, our debt market froze up. The debt market, which was never supposed to freeze up, the U.S. Treasury market, froze up today. Now, what can be done and what should not be done? Let me go through those, because this is where the four laws of Lyndon LaRouche now become absolutely the only option. First, the big Wall Street and London Center banks should not be bailed out, as financial spokesmen are now demanding. You can watch them on television. You can see them being very, very clear on what it is they're demanding. Those banks should not be bailed out. They must be broken up. Bailouts to these bank holding companies will again simply go through them to their thousands of speculative units, their client hedge funds, their investment banking units, along with the loans taken out of these big banks' deposit base in order to try to save these high loss investment and speculative units right now. Restoring the Glass-Steagall Act, if it's done immediately, will put these speculative units of the bank holding companies and also the non-banks out in the cold, where they are completely cut off both from federal bailout with taxpayers' money and also cut off from loans and other form of support from commercial banking, the commercial banking side of these holding companies, which is much larger. It will then force them to sell off these speculative units very quickly, stop lending to them, let them fail. Retirement funds will have that short time in order to get their funds, their retirees' funds, out of these speculative investments and into, for example, U.S. Treasury securities. Interest rates at this point should not be lowered further. They should be raised, and they should effectively be split into two tiers with low rates for commercial, industrial, and household lending by banks, and allowing the Glass-Steagall Act to drive up, and it will do this very effectively, to drive up interest rates for short-term speculative lending. These rates are already rising. The Federal Reserve's overnight lending to commercial banks should stay low, although not as low as presently. More important than this, the President and Congress have to cooperate to create a capital budget immediately for new infrastructure construction. They should concentrate initially on building new hospitals and other public health facilities, bringing more high-tech companies into producing stockpiles of medical devices and protective equipment, building the additional electricity capacity and clean water supplies that this expanded hospital and public health system will need. There are also plenty of other new infrastructure needed as well. Building that kind of economic infrastructure can be a very healthy activity, often to be done out in this fresh air in the spring and in the summer. New federal bonds, we could call them construction bonds, have to be issued for this capital budget immediately, either by an emergency nationalization of the Federal Reserve, which is a little bit cumbersome, or much more quickly, simply by creating a Reconstruction Finance Corporation like the one created under Roosevelt in 1933 and until 1956. That RFC to be backed by the Treasury. These bonds, should their interest rates higher than the current Treasury long-term rates, and they should be in small denominations. This will attract investment by the public. It will prevent a further collapse of Treasury interest rates, and it will encourage productive bank loans by having the RFC participate in these loans. In basic fact, neither American companies nor American working people at this point primarily need more money. They need new demand for their production, demand for their employment, demand for construction. Without that, you can loan all you want to small business. A lot of those small business loans won't even be used because those companies will not have demand to invest them in needing. Some federal taxes should be raised, not lowered. Capital gains taxes, for example, should be raised. Dedicated revenue will be needed to allow the Treasury to guarantee the short-term interest on the construction bonds if those issues are initially in the range of $500 billion to $1 trillion. It should be remembered that in the 1935 to 75 period of the most solid growth in labor productivity, solid growth in real wages, income equality, the most rapid technological advances and new industries of the last 150 years, That was accomplished with federal tax rates of nearly every type, which were far higher than they are today, and with bank lending rates in the range of 3 to 6%. So that's got to be done immediately, and it should be done on a world scale, which is why we need the President of the United States meeting and talking with the heads of Russia, China, India, other countries, Japan. We need him arranging common credit arrangements with those other countries so as to replicate this kind of building of a public health infrastructure, which is not there, and in this country is completely inadequate. In some cases, it isn't there at all. Building it all over the world, which is the kind of thing that the Bretton Woods system that FDR put in place in 1944. That was the kind of thing it was designed to do. Had he lived, it would have done that much more effectively than it did. But that is the Bretton Woods which LaRouche picked up again in 1996 and began to call for on the basis of these four nations, a heads of state summit. So I would quote what the University of Minneapolis epidemiologist Michael Osterholm said today about this novel virus pandemic and pandemics in general. We need to start now, but we're not going to fix it now. But we need to start now. However, we can fix the economy now, and that is where it is absolutely unique what dynamic Lyndon LaRouche's four laws have, with people who now know there's a very serious problem, very dangerous problem. They know they want people to be employed. They know they need things to be produced. They know they need things to be built. They know that the most advanced science needs to be applied to this problem. They know that technology needs to be fully exploited, and the United States has done that in the past. That's what LaRouche's four laws offer them and demand that they do. So let me stop with that.